Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, so today I continue my lecture on international finance topic here with the causes of exchange rate fluctuation. So as mentioned, the causes include capital movement, balance of payment, purchasing power parity theory, right, interest rate parity theory, and four-way equivalent, right? Right. Okay, next, all right. So in general, right, the exchange rate will be determined or will be at the equilibrium, right, after taking into consideration all the changes in or differential in inflation rate, changes in the interest rate, right, changes in the income level of the current accounts deficit, that is the balance of payment, that is the current account, okay, changes in the current account, and then the changes in the expectations of the future exchange rate, okay, and then changes in the government control. So by taking into consideration all these factors, so we will get new value of the exchange rate. So that means those factors are influencing the equilibrium of the exchange rates. Okay. Right. So for the first one, okay, is about the capital movement. So this is the transaction which effectively switching the bank deposit from one currency to another. Okay, and then it may influence by inflation and also interest rate. Okay, right. If we relate to the inflation, so that means changes inflation rate, right, will influence the decision makings that leads to the capital movement. Okay, so for example, a country with a lower inflation rate will lead to an appreciation of the currency. That means the currency will appreciate if the country has a lower inflation rate. And then why is that? Okay, because at that time, right, during the periods of lower inflation rate, so the price of goods and services increase at a slower rate. All right, so this will make the currency to appreciate. Okay, right. For the interest rate, right, we can relate to the exchange rate, right. Increase in the interest rate can cause the country's currency to appreciate. All right, why is that? This is because when the interest rate higher or increase, right, it will provide actually higher returns to the lenders, or it will give higher rate of return to the investors. Okay, therefore this will make the foreigner attracted to more foreign capital, and this will cause the rise in the exchange rate. All right. In other words, the exchange rate will appreciate when the interest rate is higher. Okay. Right. The next one is about balance of payment. So this is referring to the country's current account, which reflects the balance of trade and earnings on the foreign investment, that is import, export, right? So the balance of the current accounts here will influence the exchange rate as well. Okay, so we know that the balance of payment, right, or current account consists of the transactions from the export and import. Okay, so any deficit in the current account, okay, which is due to what? So when is it the deficit in current accounts happen or occur? This is when the spending on import is more than export. So this will make the current account deficit, and vice versa, where the current account can also be in a surplus, right, where the export is more than import. So what happens if the current account is a deficit, right? and also surplus. Okay, if there is a deficit in the current account, which is import is more than export, so that means it will lead to, or it will cause depreciations of currency. Okay, and then if there is a surplus in the current account where the export is more than import, okay, it will cause appreciation in its currency. Okay, right. Then, so this is what I mentioned just now, right? The government control also play important role here, or also crucial in what is it, influencing the exchange rate fluctuations. Okay, such as maybe government involved directly through the for the imposing foreign exchange barriers. Alright, that will make the import and export costly. Yeah, and then imposing foreign trade barriers. And then intervening in foreign exchange market. Okay, so affecting macro variables such as, so this will affect the macro variable such as inflation, interest rate, and also the income level. Okay, right. And then another thing that, or factors that that will influence the exchange rate, okay, is the public debt. Right, public debt. So the country with large public deficit and also debt here are less attractive to foreign investors. Why is that? Because large debts, okay, could result in higher inflation and lower currency value. Okay, right. If there is a large debt, it may prove worrisome. Okay, or makes the foreigner worry. Okay, to invest in that country. Okay, if they believe that the country's risk, all right, defaulting on its obligation, right? So there is high possibility of the country not to pay its debts. So foreigner will be less willing to own securities denominated in that currency if the risk of default is great or greater. So because of this, right, the country debt rating, which is provided by, like in our country, by rating agency Malaysia, right? Malaysia Accounting Rating Agency, RAM, okay, is very important. Okay, so that rating will be the crucial or important determinant or factor of its exchange rate. So may influence the exchange rate. So that is about public debt and that may influence the exchange rate. All right, another thing is the political stability and economic performance. Right, in this case, right, the foreign investors prefer politically stable countries with a strong economic performance. Okay, right, so any political instability or turmoil, right, can cause the movement of capital to more unstable currencies, right, or will cause a movement of capital to more, what is it, unstable currency, as there will be a loss confidence in the currency concept. Okay, so this political turmoil will make the foreigner lose confidence of the country's currency. Okay, right. Next, we want to see how does um, inflation rate influence the exchange rates. So by applying the purchasing power parity theories in detail in this case, right? So what is the PPT? PPT is actually purchasing power parity theory, right? So this is the idea of the purchasing power parity. This is the idea where the exchange rate adjusts to keep the purchasing power constant among currencies. So it implies that the exchange rate between two currency, okay, depends on the relative inflation rate within those countries. Okay, and it shows that the country with the higher inflation rate, right, and according to PPP, right, PPPT here, there is theory. It shows that the country with the higher inflation rate will be subject to depreciations of its currency. Okay, so PPP tells us that the exchange rate will rise if the inflation rate in the country is lower than in other countries. Okay, right, and then for the PPP here, right? So there is a formula, right? So that means the PPP theory can be used to forecast or to estimate the expected future spot rate, or to predict the exchange rate of the foreign country. So to estimate the expected future spot rate under PPPT, right? So we have to make use of this formula. Okay, so the formula is S1 divided by S0 equals to 1 plus HC divided by 1 plus HB. So what is S1? S1 is the expected future spot rate. So this is what we want to calculate. Okay, right. And then we take into consideration the current rate, which is the current spot rate of the two currencies. Okay, that means the foreign currencies. And then HC is the inflation rate in a foreign country. Okay, and then HB is the inflation rate in a country for which the spot is quoted, right? That is the base country's inflation rate. Okay, so we use the PPP to predict the future spot rate, okay, or the expected spot rate. Okay, um, okay. So how are we going to apply this formula? So I think you can look at this example, right? So this example stated that there is an item that costs 3,000 $3,000 in the US. Assume that the sterling and the US dollar are at PPP equilibrium at the current spot rate, okay, of $1.5 per pound. That is, this is the sterling price, okay, times current spot rate of 150 equals to dollar price. So that is how we get the spot rate or this price or exchange rate. Now the spot rate, okay, is the rate which currency can be exchanged today. So that the spot rate is the current currency, okay, the current rate. Now, if we are not applying the PPP, so the expected exchange rate or the expected currency here, right, will be determined using this method. Right, you will take into consideration the inflation rate here, right, the cost of item now, okay, 3,000 in US, right, $3,000. But if there is an expected what inflation rate 5%, right? The estimated inflation in US is 5%, right? That means in 1 year per year, so right, the estimated inflation 5% per year. So in 1 year, that means it's going to be the price going to be $3,150. Okay, right. And then if you look at the UK market for the same item, the price or the item which costs you $3,000, which is actually equals to £2,000 using this rate. Right, you convert this 3,000 into pound, then you will get £2,000. And let's say the expected inflation rate in the UK is 3% per year. So that means in 1 year's time, all right, in 1 year time, the price of this particular item, the same item, is going to be 2,060 pounds. Okay, so make use of this new price, okay, to determine the expected spot rate, all right, after taking into consideration the inflation rate, right? So the exchange rate is going to be like this, which is the $3,150 simply divide by 2,060 pounds, then you get the exchange rate for, right, 1.5291 dollar per pound. Okay, just per UK. So UK is the base currency, right? Okay, if the US is the base currency, that means you will do the other way around, and the currency will be different. Okay, right. Okay, if we apply the PPP formula, right? This one, right? So you take the figure. So as one, we know this is what we want to find out. Okay, and you divide by um, 1.5. This is the spot rate. Okay, current spot rate. Okay, $4 per pound, and then equals to 1 plus what is it? C, that is the inflation rate in the foreign country, that is in US, 5%, and then you divide by 1 plus inflation rate in the base currency, which is in the UK, 3%. Okay, therefore you can get the expected future spot rate is what is it? $1.5291. So what does it mean? So this is the US dollar per pound. Okay, so currently the US dollar per pound is $1.5 per pound. But here now it is expected that, okay, the US dollar is going to be $1.5291 per pound. So it becomes higher. So what does it mean? That means, right, the US dollar will be depreciated because you have to pay more dollar in order to get 1 pound, right? Okay, you will have to pay one more dollar, right, for 1 pound. So that means US dollar will be depreciated in 1 year time. Why is that? So now we want to relate to inflation rate. So this is because the inflation rate in the UK is expected to be higher than inflation rate in the inflation rate in the US, right, is expected to be higher than inflation rate in the UK. So that means the higher the inflation rate, that will be the lower the currency rate, right? In other words, the currency will be depreciated. In this case, US will be depreciated against the pound in 1 year time. Okay. Right, and then now the next slide is another example. How are we going to um, what to calculate, okay, the expected spot rate? Okay, we take this example. All right, hold on. Right, so I take this example. Okay, I copy here, and then I go to this. Right. Okay, so this is the example here, right? So how are we going to answer this one? So you are given the information. Okay, so that is the dollar and the, alright. So the dollar and sterling are currently trading at 1.72 dollar per pound. So that means, right? So in this case, right, if we um, start our answer, that means dollar, okay, sorry, I just go, so dollar, against pound. Okay, so that is 1.72 per or equals to, I don't know, so that means okay, equals to 1 pound. Okay, right, and then so this is the spot. Okay, current spot rate. Okay, then it is given that the inflation rate in the US is expected to grow at 3% per annum. So that means the expected inflation rate, okay, in US, okay, which is the foreign country, expected to be 3%, okay, per year or per annum. But in the UK, right, the expected inflation rate, okay, expected inflation rate, right, which is US and then UK, which is the base, right, equals to 4%. Okay, so predict the future spot rate in a year's time, maknanya in 1 year, right? So in a year's time, so here is how are we going to do that? Okay, right, so it is shown here, right? That is S1, okay, equal divided by S0 equals to 1 plus HUS divided by 1 plus inflation rate in this case, which is UK. So we just substitute S1. So what is the currency? Currency is dollar 172 equals to 1 plus 0.03, okay, and divide by 1 plus 0.04. Then you akan dapat S equals to S1 equals to 1.703. Right. So you can see that the US dollar currently is this one, right? Okay, 1.72. Now you expect that this currency is going to be 1.7035. So that means this currency is going to be what? Going to be appreciated. Okay, the US dollar, right, is going to be appreciated. Okay, right, in 1 year's time. Why is that? Alright, to relate the inflation, so because of what? The inflation rate in the US is expected to be what? Lower, right? Lower than in the UK. Alright, so that is the way that is how we apply the PPP. So this is for 1 year's time, right? Okay, maknanya next year. If it's too late this year, then next year what's going to happen in the exchange rate? So that means we can use this PPP theory to predict or to estimate the exchange rates. Okay, right. In another example, right? I do have another example. Okay, you can refer to this one. Okay, let's say I give you another information. Okay, another information, let's say, right? So, if you have the textbook, right, you can refer to the textbook actually. But then, right, let me show you the information straight away. Okay, Hold on, ah. Okay, so here the example. So suppose now, let's say, suppose, okay, the Japanese exchange rate is currently 105 yen, right, per dollar. So that means currently, right, Japanese exchange rate, so that means yen, okay, is against dollar, okay, is actually equals to yen 105 equals to $1. Okay, so this is actually SO. Okay, right, and then the inflation rate in Japan over the next 3 years, right? So here stated that the inflation, okay, rate in Japan, okay, over the next 3 years, okay, over the next 3 years will be, okay, 2% per year. Okay, whereas in US, right, in the US, okay, inflation rate, the inflation rate, okay, will be 6% per year. Okay, so based on the relative PPP, that means using PPP, right, what will the exchange rate be in 3 years? So then the question is, right, question is what will okay the exchange rate be in 3 years, right? In 3 years. Okay, so that is the question. So the question is asking you for the next 3 years, what is going to happen? Tadi kita buat example for the next year, for 1 year, after 1 year, what is the expected exchange rate? Okay, for yen. Now, how are we going to do that? So that means okay, we still using the same what? We're still using the same formula. Okay. Okay, what is the formula? Okay, future expected spot rate divided by current spot rate, you divide, equals to 1 plus inflation rate, that is H, in this case Japan, right? And then you divide by 1 plus, what is it? Inflation rate in this case US. Okay, but the question is asking you for 3 years time. Okay, in 3 years time, what will happen? Then you can simply put here for the next 3 years to the power of 3. Okay, or actually, if you look at the textbook, right, you can, if you rearrange this formula to find out S1 is actually equals to S0 and you multiply by 1, okay, plus inflation rate in Japan minus inflation rate in US, and then you put the whole thing here in the bracket to the power of 3. So if you rearrange the formula, if you don't want to rearrange, so it's up to you which one you want to use. Okay, right? So in that case, if you are using this one, so straight away you can determine what? SO, this is the SO, right? Like I said just now, this is the current exchange rate, okay, which is yen 105, and then you multiply by, just follow the formula, 1 plus, what is it? Inflation rate in Japan, which is 2%, right? Or maybe you can put 0.02, it's up to you. Okay, I put here 2% minus 6%, right? And then 1 minus negative here, so don't forget, my 2 minus 4 will be negative 4, right? Then 1 minus 4, this is not 4 line, you convert 0.04, right? And then to the power of 3. Okay, then you will get, okay, which is yen 92.9, okay, per dollar. Alright, or if you want to make use of this, okay, you want to make use of the first formula just now, that is what? S1, okay, equals to S0, right, multiply by 1 plus inflation HJ divided by 1 plus inflation US, okay, and don't forget to the power of 3 here, then put into the formula, then you will get lebih kurang, more or less the same, which is in this case 92.9, that is kalau kita approximate kan round down figure, it's 93. Okay, right. Okay, so this is PPP. Okay, right. Next, okay, we go to the next slide. Right, go to the next slide, which is about IRPT. Okay, hold on. Okay, so this is the next issue that we need to address here, right, in the relationship between the spot exchange rate, right, and forward exchange rate, and also interest rate. Okay, right. Based on the interest rate parity, right, a trader can forecast the future exchange rate between two currencies on the current market exchange rate. Right, that is the IRP, is a theory that suggests a strong, or to show a relationship between the interest rate and the movement of the currency values. Right, so the traders can predict what the future exchange rate will be based on this IRPT, right? Simply by looking at the difference in interest rates in two countries. Okay, so to get started here, then we need to know what is the formula that we can use, right, to predict or to calculate the estimated or the expected exchange rate using IRPT. Okay, right. So what is the formula? So the formula more or less the same as the PPPT formula, except that, okay, if you notice, this is for the, if you can see here, there is no S1 here, we use F. F is actually for the forward rate. Some textbook will use F1. One is means that forward forward rate, right? And then S0, as usual, this is the current spot rate, and then equals to 1 plus ICI is the interest rate in the foreign country, and then divide by 1 plus IB, okay, and then B is actually interest, IB, it's actually interest rate in the base currency. Okay, right. So in this case, you can see that there is a F here. Okay, this F is actually in IRPT is referring to the forward rates, right? In this case, we assume that the forward rate, okay, the F1 is to be or expected to be equal to the expected future spot rate, which is S1, right? S1. That means in this case, if we rewrite, okay, we can say that here, right, let me show you. Where is it to show you? Okay. Um, so let me show you here. Okay, that means F0 or sometimes some textbook will use F1. Okay, forward rate equals to um, S. Okay, so ini kena ingat lah. Okay, don't get confused. Jangan pula kita tanya kenapa tak guna F1 je. Okay, so cannot lah. Kita kena follow. Okay, but then the risk and assumption stated that the forward rate is actually equals to the spot rates. Okay, the explanation, you can see the explanations on this matter in the textbooks. Then you can read later on. Okay, so this is the formula. Okay, let me move this one upward. Okay, right. So here we can see here the IRP, right, can be used to predict the forward rates, which is forward rate equals to the expected spot rate ataupun future spot rate. All right. Okay, so now look at the example here. Okay. Okay, UK investors invest in 1 year US bond with a 9.2% interest rate, right? As these compare well with similar risk UK bonds offering 7.12%, right? So that means the interest rate in UK, right? In the UK is 7.12. In the UK is 9.2. Sorry. Oh, sorry. In the US, 9.2%, and in the UK is 7.12%. Okay. Right, and the current spot rate is $1.5 per pound. Okay, now when the investment matures and dollars are converted into sterling, IRP states that the investors will have achieved the same return as if the money had been invested in the UK bonds. So how is it? So let's say now you invest 1 million, okay, in the UK market. Let's say the value of the investment is 1 million and then the interest rate is 7.12%, right? So the total value of the investment will be 1.0712 million pound. Okay, so by referring to the available or current spot rate here of $1.5 per pound, so how much is it in the US market, right? With this 1 million pound investment in the UK market, so this one is actually equivalent 1.5 million US dollar if it's in the US market, right? And then the interest rate in the US market is 9.2%. That means the total value of investment in the US market, right, will be 1.638 million in 1 year's time. Okay. So now, how are we going to estimate, right? So that means in 1 year, right, the 1.0712 pound million must equate to 1.638 million dollars. So what you gain in extra interest is you lose on the adverse movement in exchange rate. So the forward rate moves, right, to bring about interest rate parity amongst different currencies. So that means by using this information, after taking into consideration the interest rate here that affecting the investment value, then you can predict the exchange rate, right? So which is, right, dollar to pound. So that means dollar 1.638 million dollar, right, divide by pound, that is per pound, all right, divide by pound, of 1.0712 million pound. That means, right, the exchange rate dollar per pound equals to 1.5291 dollar per pound. Okay, so this is the method without applying the IRPT. Okay, if you are using the formula of IRPT, so we are going to get the same answer here actually. Right, you just plug in the figure and then you substitute or put the figures into the formula, which is this is the one that we are going to find out. Okay, the forward rate, which is equal to the expected uh, expected future what of spot rate. Okay, so that means right, f 0 equals to right $1.50 and multiply by this one. Okay, times 1 plus 9.2% divided by 1 plus 7.12%. So what is 9.2%? This is the interest rate in the foreign currency, which is in US, right? And then this is the interest rate in the base currency, right, which is in the UK, 7.12. Right, then you akan dapat the forward rate of 1.5291. So that means, right, under IRPT, using IRPT, it is predicted that the country with the higher interest rate, right, which is 9.2%, will see the forward rate for its currency subject to a depreciation. Why is that? Because currently, right, the exchange rate for dollar per pound is 1.5 divided by per pound, right, $1.5 per pound. But now, okay, after you using the IRPT, by taking after you take the interest rate into consideration, right, then it is expected that the exchange rate is going to be $1.5291 per pound. So it's going to be higher in 1 year's time. So what does it mean? That means the US dollar is what? Going to depreciate against pound. Okay, that means the what? Um, uh, if we want to convert into pound, that means they have to pay more dollar. Okay, right. Okay, next here. Okay, right. In another example, right? Maybe we can look at the example. Okay, let me show you. Okay, example of IRPT, right? So this one, I can use this example, right, to make you more understand in IRPT. Okay, so let me show you. Okay, um, this one. Okay, right. So yeah, then I share you this one. Okay, go to this one again, and then here I take this one, and then this one. Okay, right. So now, okay, let's say from this example, right? So example from the textbook. Okay, just in case if you don't have the textbook, so I just take the important information. Let's see here, suppose, okay, the exchange rate for Japanese, okay, right, so here, suppose, right, the exchange rate for Japanese, Okay. Yen, or Japanese yen, is currently at this one, which is yen. 120 yen is equal to $1. Okay, so this is the yen's value per dollar. Okay, so that means this is actually current spot rate. Okay, the S0. Okay, now if the interest rate, let's say, okay, if okay, um, okay, the interest rate in the United States, okay, if the interest rate in the United States is 10%, right? So this is interest rate in US, whereas the interest rate in Japan and interest rate in Japan equals to 5%, okay, which is lower than US. And then so the question is, what, okay, must the forward, Noah, tolong tekan switch tu. Ambil wire charger. Charger. Okay. Right. So what must the forward rate to be? Okay. Right. So using IRPT lah. Okay. So how are we going to do that? Right. So go back to the formula. Okay. The answer here is F. So if you want to use F0, go ahead, or F1 pun boleh. Okay, equals to, what is it? 1 plus, okay, 1 plus interest rate in Japan, right? And divide by 1 plus interest rate in US. Ataupun, kalau kita simplify, sebenarnya F0 can be calculated. We just rearrange this formula. It will become like this, which is S0 multiplied by 1 plus, right, interest rate in Japan minus interest rate in US. Okay, sama je. Okay, so if you want to use this formula, the original formula here, so that means F0, right, yen 120 equals to 1 plus what? Interest rate in Japan is 0.05. Okay, you divide by 1 plus interest rate in US. So 0.1, right? So then you will get equals to how much? 114. Is it 114? Let me check. Okay, 1.05 divided by 1.1 multiplied by 120 yen. So you get 114.5. Okay, right. So that means ini akan dapat 1 yen 114.5. Okay, if you're using this one, this formula, okay, so F, okay, F 0 equals to yen 120 multiplied by 1 plus Japan 5% minus 10%, 0.05 lah. Okay, so therefore you akan dapat F0 equals to lebih kurang, okay, walaupun ada perbezaan in the answer, it's just an subject to decimal places, I guess. Right, you akan dapat answer 214. So it's up to you. Okay, right. So this is how the IRPT is what applied here. Okay, to predict the exchange rate. So that means in this case, what happened to the yen currency? What happened? So you can notice that, right? This one. Okay, you can notice yen currency currently is 120, and now it becomes what? 114 only. So let's say we use 114.5. So per dollar. So now it becomes cheaper now to buy dollar. Okay, so what does it mean? So that means yen is going to be appreciated. Hold on, let me. Okay, it's going to be appreciated. Okay, US dollar appreciates. So why do you think it's going to depreciate in 1 year's time? Why do you think the US dollar appreciate? You can see if you want to relate to what? To the Japan interest rate. So this is because interest rate in Japan is expected to be lower than US. Okay. Alright, so that is about the IRPT class. Okay, I hope you understand, right, with my explanations regarding IRPT and also PPPT. Okay, PPPT is the theory that includes the inflation rate to predict the exchange rate. If you are using IRPT, so this is the theory where showing the relationship between interest rate and the exchange rates. That means by taking into consideration the changes on the expected interest rate in order to predict the exchange rates of the country. Okay, two countries lah, in other words. Okay, so that's about it for IRPT. Right. Okay, now we go back to the slide. Okay. Right, the slide. So this are the limitation, right? Expectation theory. This one you can read. Right. So, right, we go to the international Fisher effect. Right. Hold on. Okay, we'll go to this one. Okay. Right, international Fisher effect. So this is actually the theory by, right, developed by the US economist named Irving Fisher, if I'm not mistaken. Irving Fisher. Okay, so this theory actually states that differences in nominal interest rate between currencies can be used to predict the changes in the exchange rate, right? And then according to IFE here, that is international Fisher effect, right? The countries with higher nominal interest rate, okay, experience higher rates of inflation. So this will result in currency depreciation against other countries. So in other words, right, the international fisher effect here actually provide the assumptions that the countries with the, let's say, lower interest rate, so will likely also actually experience lower level of interest rate, right? The countries with lower interest rate will likely also experience a lower inflation rate, right? So this will result in increase in the real value of the associated currency as compared to other currency. That means it will result in currency appreciation. Okay, right. So that is about international fisher effects. And then the next one is the four-way equivalent. Right, so this is the theory, right, or favorite four-way equivalent. Show the four theories, that is IRPT, PPPT, right, the international Fisher effect, and then the expectation theory, right, and put together to show the overall implication or to show the overall interactions between the spot rate, interest rate, inflation rate, and the forward and expected future spot rate as well. All right, so this is shown in the following diagram here. Okay, so very complicated actually, right? In other words, it describes, right, the four-way equivalent here is describing the interaction, right, between the key financial variables such as interest rate, inflation rate, as mentioned here, the forward and expected future spot rate. Okay, um, then the implications here, right? The implications of these relationships are actually explored and or shown as a group, okay, in order to forecast the exchange rate. So that means they are taking into consideration all variables here, okay, in one basket. They pull together in one basket in order to estimate the or to predict the exchange rate or to forecast the exchange rate. So this is the comparison of the IRPT, PPPT, and the IFE. Okay, right. So IRPT focus on why the forward rate differs from the spot rate. Okay, and on the degree of difference that should exist. It relates to a specific point in time, right? The PPPT and the international Fisher effect here focus on how the currency spot rate will change over time. Okay, right? And whereas PPP suggests that the spot rate will change in accordance with inflation differential, IFE suggests that it will change in accordance with the interest rate differential. Okay, right. And then PPPT is related to IFE because expected inflation, because PPPT itself is actually describing the relationship between inflation and exchange rate, right? And then uh, the IRPT is described, the theory that describes shows the relationship between what? Interest rate and between relationship between interest rate and the exchange rate. Okay, right, and they also analyze and focus on the um, factors of why the forward rate differ from the spot rate. Okay, so that's about it for the causes of the uh, exchange rate fluctuations. So basically, the causes of the exchange rate fluctuation here is due to the differential in, right? The basic idea here is shown here in the earlier slide, right? The exchange rate is influenced by these changes, right? Differential inflation rate, interest rate, right? And the balance of payment, that is the current accounts balance, right? Deficits or surplus, right? And then government policy or government control, okay, and then the expectations of the future exchange rate, okay. So these are the factors. So the changes or the inflation, interest rate factors are actually explained in detail how these two factors influence this exchange rate in detail, right, via the theory that is called as PPP and also what IRP. Okay, so if you're talking about inflation, that means we apply the or we refer to the PPP theory. Okay, where we use this differential to predict the um, exchange rate, right? And IRPT, right? So IRPT is where the theory where the trader predict the exchange rate based on the differential in the interest rate. Okay, right. So later on, right, you can read, okay, on your own about the causes of exchange rate fluctuations. Okay, so hopefully you know how to apply the formula. Okay, so next part I will discuss on this one. Um, okay, let me show you. Is this the one? Oh no, this one. Right, the basic method of foreign risk management. So this will be explained in the next meeting. All right, thank you class. Assalamualaikum. Okay, Assalamualaikum warahmatullahi wabarakatuh. Okay, so today I continue with basic methods of foreign risk management. Okay, so this is dealing with the transaction of import and export, right? Where payments and receipt depends on the exchange rate, and the exchange rates are subject to the fluctuation. Okay, and the risk management here actually relates to the policies, techniques, or strategies that the firm may undertake or may adopt, right, to manage the risk it faces. All right, by taking measures to eliminate or to reduce the risk, right? So this is actually called that the company is hedging the risk or hedging the exposure from the uh, exchange rate fluctuations. Right, so there are many techniques can be used, right, to reduce the risk or to manage the foreign risk, right? So here are the internal hedging techniques that are currency invoice, leading and lagging, netting and matching, and then forward exchange contract and money market, right? So we go to the next one. The first one is about the currency invoice. So this is where the company arrange for the contract, right, and the invoice to be issued to be in home currency, right? So this will actually will transfer or will shift or pass all the transaction risk from from your company, let's say from your company to other party, right? So the objective of this strategy is actually to eliminate the transaction risk by transferring the risk to the um, foreign supplier or to the foreign customer. Okay, in general, we could say that it means that, right, your company insists all the foreign customer to pay company in home currency. That means if your company is exporting goods or services to foreign countries, so that means you require your foreign customer to pay in your home currency. Okay, and vice versa. If your company pays for the import, let's say your company import goods from foreign supplier, right? And your company will pay the import in your home currency, and then that means the foreign seller will convert it into their currency, and um, automatically the foreign supplier will bear the transaction risk. So as a result, the transaction risk, right, will be borne by the um, foreign supplier, okay, and also by foreign customer if it's an export transactions. However, the company must aware of the consequences if the company using this strategy, right, by transferring the transaction risk to another party. Okay, why is that? Because as the company pass the or transfer the transaction risk or risk to the foreign customer or foreign supplier, so it will um, make them not happy with the strategy, right? So it would create the negative consequences, where they will shift or will move, all right, to other sellers or other suppliers, right? Um, So here we could say that the goal of the currency invoice strategy is only achievable if the company is in the monopoly position, right, and not in the competitive market. So it's not effective if the company have the competitors in the market, right? Why? Because these foreign customer and foreign supplier, what is it, become not no longer interested to have a business with our company. Okay, and they will go to the competitors, in other words. Okay, the next one, we go to the second strategy, that are leading and lagging, right? So this is actually the strategy that can be called as the speculative strategy, and this is very risky to the traders, right? Why is that? Because it's subject to the predictions of the exchange rates movement in either direction, whether the exchange rate is predicted to decline or to appreciate, to increase, right? To appreciate or to depreciate. Okay, right. So why is that the leading and the lagging strategies here are considered as a risky strategy? Because it will not give any benefits if the prediction of the currency value um, is not correct, right? If it's not giving any benefit, if the prediction is not correct. So now we go to the leading and lagging specifically one by one. Okay, we go to leading first, right? Leading means that making a payment earlier or early, okay, in the currency that is expected to appreciate against your own currency. Okay, right. We take a simple example here. Let's say you plan to go to Singapore and you predict that the Singapore dollar will strengthen next month. Okay, um, right. Strengthen, that means the Singapore dollar is predicted to be appreciated against your own currency, okay, that is ringgit Malaysia. So then what will you do if you predict that the Singapore dollar is going to appreciate next month? So that means you, right, might change or might convert RM to Singapore dollar earlier, or maybe today or now, right? Why is that? Because if you wait until next month, that means you have to pay more ringgit Malaysia in order to get $1. So in other words, dollar become more expensive, right? Okay, so that's why you do the bidding, where you will convert the ringgit Malaysia to Singapore dollar as soon as possible. Okay, and then we go to lagging, right? Lagging here means the making a payment as late as possible. So that is the company delay the payment right, in the currency that is expected to depreciate, that is to be weakened against your own currency. So again, same example, let's say you predict that in 1 month's time the Singapore dollar is going to be weakened against ringgit Malaysia, that is depreciate against ringgit Malaysia. So what happened is Singapore dollar is predicted to be depreciated. That means ringgit Malaysia is going to be appreciated. So what does it mean? That means the Singapore dollar now become cheaper, right, and less ringgit Malaysia's required to convert into Singapore dollar, right? So then what would you do if you predict that Singapore dollar is going to be depreciated, right? Then you will not convert the ringgit Malaysia to Singapore dollar now, right? So you will delay the conversion, right? And then in other words, you will not change your ringgit Malaysia into Singapore dollar until the last possible moment. Or in other words, you delay the exchange until the right time, and maybe when you really need to convert into Singapore dollar. Okay, that will be better off to you. Okay, right. So then we go to the next slide. Okay, we refer to the example. Okay, all right. In this case, okay, in the example, it is stated that, right, the company, US company, right, it's a US company, import goods from the UK, and then the company here, the US company, is due to make the payment of 500,000 pounds. So the payment is 500 is in pound. Okay, so that one you have to take note. So the payment, right, by the US company is in pound sterling to the UK supplier in 1 month's time. Okay, and then it's given that the current exchange rate, that is the spot rate, is what? For every dollar, right, it equals to 0.645 pound. Okay, so that is the current exchange rate per dollar. Then the question is, in the first situation, all right, first situation, it states that if the um, dollar is expected to appreciate. So here, if the dollar is expected to appreciate, that means the pound is expected to depreciate. Okay, right. So if the dollar is expected to appreciate by 2% in 1 month's time, and then there will be a further appreciation by 1%, okay, in the next 2 months. Okay, right. So what does it mean? Okay, if the dollar is predicted to appreciate, so that means I mentioned earlier the pound sterling is going to be depreciated, right? So that means, right, the US company is going to pay in pound, right? That is expected to depreciate, correct? So the pound is depreciating, right, in 2 months' time, right? And then there will be less dollar to be converted into pound. As the dollar become is predicted to be appreciated, that means there will be less dollar um, to be converted into pound. So it is become cheaper. Okay, if the dollar is predicted to become cheaper for the US company, right, to pay in pound. So, okay, so therefore, US company should adopt lagging strategy. Why is that? Because the what? The currency, the pound currency is expected to depreciate. Okay, right. The next thing here is when is it the company should pay? Is it in 1 month's time or is it in 2 months' time? So which one will be better off to the company? Okay, so look at this calculation here. right? If the dollar appreciates against sterling, so I mentioned here, this means that the dollar value of payment will be smaller in 2 months' time. So that means it is better for the company to delay the payment, right? To delay the payment, right? Therefore, it adopts lagging approach, right? That is, it will delay payment by an extra month to reduce the dollar cost. So it will delay the payment, right, until the second month, even though the amount is due in 1 month's time. So this will give another implication with the supplier in future. But talking about lagging here, so here, so let's say if the company pay in 1 month's time, so how much dollar should be spent here for 500,000 pound? So the exchange rate currently is 0.6450 pound per dollar. So that means if it's expected to appreciate, right? So 0.6450 will multiply by 1.02, then it will be equal to 0.6579 pound. So what does it mean? You can see here, right? When the pound become depreciated, so the pounds will be um, the what? There will be more pound to be converted into $1. Okay, or for $1, right? So it becomes more expensive, right, to convert pound into dollar. But for the US company, um, there will be what? Less dollar to be converted into pound. Okay, right. And then how much dollar here? So 500,000 pound divided by the new X currency or exchange rate, which is 0.6579. So the amount of dollar that is equivalent to 500,000 pound is $759,994. This is the payment that will be or should be made by the US company, okay, in 1 month's time. But what happened if this US company delay the payment until the next 2 months, right? So the next 2 months, it is also predicted that the US dollar is going to appreciate. And then that means the pound sterling is keep on depreciating, right? It's going to depreciate more by 1% here. Okay, what happened then to the exchange rate? So that means from 0.6579, it will what? Become 0.6645, where 0.6579 multiplied by 1.01. Okay, so then more pound now. Is it more pound? Yes, more pound, right? Okay, more pound to be converted into $1. Okay, right. So then what happened to the US company? So that means there will be lesser, okay, dollar amount. So 500,000 pound, you divide by this latest rate, 0.6645, and then it's equivalent to 752,000, okay, and $445. Okay, so that means there will be less dollar to be converted into a pound of right, that is equivalent to 500,000 pounds. So it becomes cheaper to the US company, right? So that's why the US company prefer to delay, to lag, all right, to delay the payment. So this is what we call lagging strategy. Okay, right, by delaying the payment by an extra month, by one more month, right, the US company will save $7,559. Okay, so it's a difference between this amount and this amount. Okay, right. In the next situation, what kind of strategy that William Limited will undertake, right, or implement here. If, right, in the second situation, if the dollar is going to weaken, right, if the dollar is going to weaken, that means going to depreciate against the sterling. So what does it mean? If the dollar is expected to depreciate, that means, right, the sterling is predicted or expected to appreciate, right? If the dollar appreciate against sterling, sorry, here, depreciate, if the dollar um, depreciates against sterling, so what strategy and what does it mean actually? Right, so in this case, okay, I can stay here and say here, right, dollar depreciate, okay, will depreciate. So thus, sterling will appreciate. Okay, so that is the meaning of this situation. If the dollar is predicted to depreciate, the sterling is sterling. Okay, right, the sterling is predicted to appreciate. Hold on now. Sterling. Okay, will appreciate. So what happen if the sterling appreciate? Okay, if the sterling appreciate, okay, that means there will be more dollar to be converted into pound. That means the US company has to pay more dollar, right, for 500,000 pound. Okay, so what should the US company do here? So that means the US company should make earlier payment, right, to avoid um, the what? To avoid the increase in the um, pound sterling currency. Okay, right. So the US company is going to pay in sterling, right? That is expected to appreciate. So there will be more dollar to be converted into pound. So the company should adopt leading strategy. So the US company should pay as soon as possible. Okay. So let's say if the US company pay in 1 month's time, okay, um, so the exchange rate will become 0.6321 per dollar, right? And then the amounts of dollar to be converted into pound will be 791,014 dollar. Okay, so this is the amount that the US company has to pay when the pound sterling is expected to appreciate. Okay, what happened if the US company wait until the next month or delay the payment instead of paying earlier? So what happened? So the pound sterling, as predicted, will what uh, will appreciate, okay, further by 1%, right, as as the US dollar predicted to um, depreciate further by 1%. Okay, therefore, the new exchange rate pound per dollar is 0.6258 by multiply by 0.99. Okay, right. So with this new exchange rate for the next 2 months, right? So the amounts of dollar that has to be paid for the import is what? 798,977 dollar. So you can see that there will be more dollar, right, to be converted into pound and to be used for imports. Okay, so it will make the imports more expensive. if the US company pay in 2 months' time. So that's why the company will adopt leading strategy. Right, will try to pay as soon as possible if the pound sterling, right, is expected to appreciate. All right. Okay. All right. So this is another example. Okay, for leading and lagging to test our understanding here. So let's say in this example, again, US company is importing from China, and the goods from China cost the US company 10 million renminbi, that is RMB, China currency, which is due in 3 months' time, right? And then the treasurer in the US company believed that the US, the exchange rate, right, of US dollar and RMB exchange rate will move from its current rate of what, 6.13 RMB per dollar to 6.08 RMB US dollar, okay, in 3 months' time. So what does it mean here from the exchange rate prediction? So that means, right, the treasurer of the US company predict that, what is it? The RMB is predicted to appreciate. Okay, right? Why appreciate? Because there is going to be less RMB currency for $1. So it becomes cheaper, right, for RMB to be converted into dollar. All right. Okay, so since the US company will pay the import in RMB currency, so which is expected to appreciate in 3 months' time, so that means, what is it? Okay, that means there will be more dollar will be converted into RMB in 3 months' time. I think the US company has to pay more dollar, right, to pay for 10 million RMB imports. Okay, the value of the import is 10 million, right? So to pay the 10 million RMB to the China supplier, right, there will be what? More dollar. Okay, so then how to minimize this risk? Then the US company will adopt one of the strategy, which is what? The US company will adopt leading strategy, right? Because it will better off. That means the the US company will pay as soon as possible and will pay at the current spot rate here, which is 6.13 RMB per dollar, instead of waiting until next 3 months and then make payment. If the US company wait until next 3 months and then make payment and then assume that the prediction is correct, so that means the US company will loss. Okay, right, will be at loss. Okay, now, so we have identified that the US company should adopt leading strategy. Identify the strategy that should be adopted by the US company is leading strategy. So now let's say if the US company pay now, okay, that means we'll pay at 6.13 RMB per dollar, okay, in order to eliminate the potential risk from the exchange rate. So therefore, the amount of dollar that the US company should pay for 10 million RMB equals to 1.631 $631,321. Okay, so this is the amount of dollar that should be converted into RMB to get 10 million or to pay 10 million RMB to the China supplier. So this is the leading strategy. But what happened, right, if, okay, let's say here I show you, okay, if Also, this one I have shown here or stated here. So what happened if the US company pay the China supplier in the next 3 months and then assume that the prediction is correct, right? Which is the RMB is what? As predicted to be appreciated, right? From 613 RMB to 608 RMB. So what happened if the US company wait until 3 months to make the payment? Then the US company has to pay in dollar 1,644,734 dollar, which is higher than this one. Okay, so that means it becomes more expensive if the US company wait until the next 3 months to pay the China supplier. So that's why the US company should adopt leading strategy. Okay, now the next issue here is, like I said earlier, so leading and lagging is actually risky. What happens if, right, the prediction is not right? That means the actual exchange rate, okay, of RMB per dollar is actually 6.15 RMB per dollar instead of 6.08 RMB. So this is the prediction, all right, the predicted currency of RMB, and this is the actual. That means, in other words, the prediction is not correct. So what happened to the US dollar? So the US dollar actually will be at lost, right? Because it's already the US dollar is actually already undertaken or adopted the leading strategy just now, right? So that means if the prediction is not correct, that means the company is actually at loss. Okay, if the company waits until 3 months time, that means the company will pay the China supplier less dollar, right, or spend less dollar for 10 million RMB. But here it's already adopted. That means the US company is at loss. Okay, right. So that's why we say here the leading and lagging is very risky. Okay, especially when the predictions of the exchange rate, right, is not correct. Okay, right. The next one, we go to netting and matching strategy, right? So actually matching is where the company has the sales transaction with one foreign customer and then a purchase transaction with other foreign customer. Okay, both foreign customer are in the same industry. Okay, foreign supplier. That means matching is where the company has a sale transaction with one foreign customer and then a purchase transaction with other foreign supplier. Okay, so both foreign transactions here are in the same country, and then that means they are made, the transactions are made, the sales and the purchase transactions are made using the same foreign currency. Betul? Okay, for example, let's say on the 1st November, the company received 2 million US dollar from the US customer, and then on 15 November, right, company A pays 1.9 million US dollar to the US supplier. Okay, so this is for one for export, another one for import. So the difference here, all right, the import and the exports are matched to each other, all right. So this will leave only the balance of 0.1 million dollar US dollar, right? And then this strategy will work effectively if there are many sales and purchases, right, or many export and imports, to get the benefits from matching strategies. And then you must bear, or we must aware of this one, which is it is not feasible if the transactions are separated by many months. Because for example, on the 1st January, you receive 2 million US dollar from the export, but then for import, you're going to make the payment somewhere in March, right? The following year, right? 1st November, you receive, and then next year, somewhere in March, let's say 15 March, you will make the payment to the US supplier. So there is um, what is it? A big gap between the receive and the payment, right? So here, uh, the benefit of matching maybe cannot be realized, right? Right. Then we go for netting. So netting is actually just more or less the same as matching. Okay, right? So there are um, this one. There are two netting strategy that are bilateral netting, right, and then multilateral netting. Okay, so for bilateral netting, will be only two companies involved, right? For multilateral netting, right, it will involve more than two group companies, and then the amounts will be netted off, and then leave the net balance from the transactions, right? So we go to the example, right? Go to the example here. So the example here is about multilateral netting. So P, right, is the parent company of the group that consists of three subsidiaries that are subsidiary in Europe, subsidiary in US, and subsidiary in Canada. Okay, right. So look at this one. Um, and then it's mentioned that the following cash flow are due in 2 months' time between the parent company and its subsidiary. And required, calculate using the tabular method, alright, from format, the impact of undertaking multilateral netting by parents and its three subsidiary company for the cash flow due in 2 months. Right, so how are we going to show the implications from the netting strategy here? Okay, so look at this one. Okay, the what? The foreign currency must be converted into the parent's currency, which is pound in this case, right? So note that all foreign currency amount have to be translated into pound using the given matrix. Okay, so let's go for the first one, which is the amount owed by P, right, to S, and the amounts owed by P to S is 3 million dollar Canada. Okay, so this $3 million Canada, okay, actually must be converted into pound. Okay, so who pay who? That means who made the payment, right? So that is the parent will pay to S is what? Canada. So parent company will make the payment to Canada. Parent company will make the payment to US subsidiary. So look at how are we going to show it in the table. Right. So here the parents make the payment paid to. So this is the column for the receipts. So this is the column for the payment. Okay, so P paid to S just now, right? Which is Canada. So how much in pound? 3 million you divide by Canada's exchange rate to against a pound is 1.5. That is 3 million divided by 1.5. Then P will pay to Canada 2 million pound. P will pay to R is US. Okay, and how much? 5 million dollar US dollar. Okay, and then 5 million you divide by 1.6 to convert into pound. So this is the exchange rates of US against pound. Then how much the parents pay to US subsidiary? So it is what? 3.125. So that means um, um, P will pay to S, P will pay to R. Okay, and then you continue with other transactions. And then you just put into the table. Right now, we want to total up the amounts, right, received by parents is 7.083 million pound. Okay, so you do it horizontally. So this is the amount that P received. And then this is the amount that the subsidiary in Q is in what country? In Europe. So this is the amount that is received by the subsidiary in Europe, right? And we do it horizontally. But if you do it vertically, right, for P from top to bottom here, right, from this row, from this row to this row, right, then you will get 5.125. So that is the payment. So this is the total payment made by P to each subsidiary. So you total up the payment and then you compare to the receipts, okay, of each subsidiary accordingly. Then you get the net. So they are netted off, okay, and then you get the net balance. Okay, right. Okay, next, here we can see another example. Okay, netting receipts and payment here. C and D are respectively South African and US based subsidiaries of the UK holding company. Okay, so if C owed 300,000 pound and D owed C, yes, C hutang dengan D dan dia kena bayar D 300,000 pound, and then right at that time, at the same time, D or owed to C pula 200, amounting 220,000 pound. So you compare to this between these two figures, and the company in the two companies, right? Two intercompany balances can be netted off, right? You compare or you net it off, and then it will leave the net debt owed by C of 80,000 pound because C owe more than D. Okay, right? Okay, right. So this is what I mentioned about matching, right? Okay, matching objective is to reduce the exposure to currency risk. Right? When the company has received and payments in the same foreign currency due to at the same time, it can simply match them against each other. So this is similar to example that I gave you earlier. Right? It is then only necessary to deal on the foreign exchange market for the unmatched portion of the total transaction. So the terms netting and matching are often used interchangeably, maknanya it's just the same, right? But strictly speaking, they are different. Okay, all right. Okay, this is the example. Okay, netting and matching. So this one, let's say a Malaysian company will receive 20 million in 4 weeks and must pay out 18 million in 5 weeks, right? So the difference is only 1 week, right? So exchange rate, transaction risk, right, is substantially eliminated by opening a US dollar bank account. Okay, the company open the bank account. Okay, and then using the receipts of 20 million US dollar to pay the 18 million. So it will reduce the transaction cost. Okay, so it works best if there are many inflow and outflow into the bank account and out of bank account. That means receipt and payments, multiple receipts and payment. Okay. Okay, so to give the opportunity for matching, that is to reduce the risk. Okay, right. So this is about forward exchange contract. So I think I stop until here, right? And thank you class. Assalamualaikum.